Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in.
Okay, happy Thursday everybody. Today's video will be very much focused on the Chinese economy. There are several major updates which we need to discuss. In the last 24 hours, US outlet Bloomberg broke the news that Evergrande chairman Hui Kaiyan has been placed under police control, once again putting the massive property developers' restructuring plans in doubt. This news follows other reports in recent days that several other executives have also been detained. According to multiple unnamed sources speaking to the outlet, Hui was taken away by Chinese police earlier this month and is being monitored at a designated location. It's not clear why Hui is under the so-called residential surveillance. In a Wednesday note, analysts from Singapore-based United Overseas Bank Limited wrote that Evergrande is, quote, very likely to fail on debt restructuring, and with negative equity, Evergrande may go into bankruptcy, which includes bankruptcy reorganization and bankruptcy liquidation, end quote. The brokerage added that the developers' already sold but unfinished apartments, quote, will pose a risk to social stability, end quote. UK-based Reuters, writing on the implications of these arrests, expressed that Evergrande has been in the process of seeking its creditors' approval to restructure offshore debt worth $31.7 billion, which includes bonds, collateral, and repurchase obligations amid weakening cash flows. But the weekend announcement it could not issue new debt due to the regulatory investigation underway into one of its main Chinese units, as well as these arrests in recent days, including of the chairman, quote, has thrown these plans into disarray, end quote. Now, moving from the tree to the forest, that is, the housing sector generally, according to the quarterly investor sentiment survey published by the Chong Kong Graduate School of Business in Beijing, China investor poor sentiment on property has reached record levels. The survey published this week shows that the net share of respondents planning to cut their investment in domestic real estate over the next year rose to a record 31.7% in the third quarter of this year. The share of investors predicting that secondary market prices will rise in first and second tier cities over the next year fell to 47.6%, the lowest level on record since the survey began in 2018, indicating deep investor pessimism when it comes to property values. Meanwhile, US outlet Bloomberg reports that China property stocks have slid to their lowest levels since 2011. Yesterday, Wednesday, a Bloomberg intelligence gauge of developer shares closed down 3.5%, with the biggest drag on the index being CIFI Holdings Group Co., which plunged 59% as trading resumed following months of suspension. The gauge is down more than a third for the year. Quote, investors are bracing for further troubles at some distressed builders after policy support failed to drive a sustainable recovery in home sales, while developers are counting on the Golden Week holiday to revive sales momentum. A stream of negative headlines on the sector's distress may keep buyers away, end quote. US outlet The Wall Street Journal writes this week that the long-held belief among economists that property-related dangers to China's financial system are low risk because, in part, home buyers tend to make large down payments is now coming under scrutiny. A recent ANZ Bank note warns that a sudden drop in prices could undermine this conventional wisdom. In the note, the ANZ analysts explain that, quote, if property values drop 30% in China, as much as they fell in Tokyo and Hong Kong during past downturns, about 12% of the country's 5.3 trillion mortgage book, or about 640 billion in mortgages, would have negative equity, end quote. The Wall Street Journal article adds, if prices drop by half, about 51% of mortgages would be underwater, end quote. Next up, we have several more economic updates to cover. If you're enjoying today's episode of China Update, don't forget to hit the like button. Liking, sharing, subscribing, these are all big helps for the channel. And for anyone who wants to go the extra mile and help me keep China Update financially sustainable, the channel relies primarily on subscriber support to keep going. Patreon and Buy Me a Coffee links are in the description below. As always, thank you so much, everybody, for the ongoing support. Yesterday, Wednesday, the People's Bank of China, China's central bank, published the official readout for its Q3 meeting. There were no big surprises in the document. We just take note of some of the main points therein. The central bank said it would step up policy adjustments and implement monetary policy in a precise and forceful manner, adding liquidity will be kept reasonably ample and maintain stable credit expansion. The bank further expressed, quote, "The foreign exchange market is basically balanced in supply and demand. The current account surplus is stable. Foreign exchange reserves are sufficient," end quote. But continued, quote, "The current external environment is becoming more complex and severe. International economic trade and investment are slowing down. Inflation remains high, and developed countries' interest rates will continue to remain high. The domestic economy continues to recover, rebound, and strengthen, but still faces challenges such as insufficient demand," end quote. Though it isn't discussed in the official meeting readout, a surge in Chinese sovereign debt issuance is also increasing pressure on the People's Bank of China to keep funding conditions loose. In September, so far, the Ministry of Finance has sold 1.2 trillion yuan, $164 billion of central government bonds, the highest monthly tally of the year, and 60% higher than the average for the same period in the past 3 years. Meanwhile, and this is related to the banking sector as well as the property industry, according to a research note published yesterday by JP Chase & Co. analysts, Chinese banks' earnings may fall as much as 10% in 2024 if their bad debt ratios continue to rise on defaulting developers. The note explains that the developers' non-performing loan ratio for banks is expected to rise to 7.5% from 4.5% as of the first half of 2023, in the firm's base case scenario. However, if all privately owned builders and so-called low-quality state-owned developers were to go into distressed status, then the ratio could go up to 13%, quote, pushing earnings down by 10%. Regular viewers know that China's banking sector has been under a lot of pressure, being hit both on the lending side as well as through high exposure to property sector related assets. And finally, for today's video, regular viewers also remember that last week the State Council approved a special action plan for clearing arrears of enterprises, and we discussed the systemic risks associated with high levels of arrears in the economy. This week, the local government of China's so-called Inner Mongolia Autonomous Region announced plans to issue 66.3 billion yuan, $9 billion of refinancing bonds in October to pay off debts owed to businesses. Quote, "It will be the first borrowing by a local government to make overdue payments to private businesses in response to a State Council directive, September 20th. China's cabinet ordered state-owned enterprises and provincial-level governments to pay their debts to businesses," end quote. The alert explains that refinancing bonds were originally used to pay off local government bonds. As part of a 2020 trial program to diffuse local governments' hidden debt risks, the use of refinancing bonds was expanded to cover such hidden debts. The borrowings are mostly concentrated in local government financing vehicles. But with this news from Inner Mongolia, the outlet observes that, quote, "This bond issuance will represent an expansion of the program to include repayment of arrears owed to businesses," end quote. Thus, the slow-moving crisis that is local government fiscal stress goes on. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a wonderful Thursday, and I will see you all tomorrow.